The cash budget, which shows expected cash receipts and disbursements during a period, is impacted by all of the preceding budgets in the master budget. A detailed cash budget will point out when a company has excess cash to invest and when it has to borrow funds. This allows a firm to earn maximum interest on excess funds and to avoid the costs of unnecessary borrowing. Typically, a cash budget is divided into 3 sections: cash receipts, cash payments, and financing. The cash receipts section summarizes all cash expected to flow into the business during the budget period. Because many companies generally extend credit to their customers, a lot of their sales are originally recorded as accounts receivable. The collection of accounts receivable is a major source of cash, and its timing is an important consideration in preparing a cash budget. Over time, a company can get very good at forecasting its cash receipts. You can identify patterns in terms of when customers pay and apply those patterns when forecasting what the future cash receipts will look like. Now, the cash payments section of a cash budget is a bit more involved. This is because so many different types of cash payments are involved: payroll, rent, advertising, research and development, all different sorts of cash outflows. But again, over time you can see patterns in terms of those cash flows, and those patterns can be incorporated into your cash budget. By combining the expected cash payments with the desired ending cash balance, you can forecast total cash needs for each quarter and then compare that need with the total amount of cash you expect to have available during the quarter. The final section of this budget reports the cash excess or deficiency as the difference between budgeted cash availability and budgeted cash needs. If a cash deficiency is forecast sometime in the future, a company can start making plans now. No one wants to walk into a bank and say, "I need $50,000 yesterday." Knowing, based on careful forecasting and budgeting, that you will need $50,000 in 3 months to get you through a temporary cash shortfall allows you plenty of time to make plans to resolve the issue. The financing section allows you to identify when a cash surplus might be available and when a cash need will present itself. It allows you to incorporate the timing and amounts of all projected borrowings and repayments during a period. Banks appreciate and sometimes insist that companies plan their cash needs in advance. Because money has a time value, management always walks a tightrope between having too much or too little cash on hand.